I don't know why I'm nervous today. Why don't you guys tell me something funny? So this segment, that's Jocelyn's hand. So this segment is on the California Housing and Finance Authority program. Thank you, Ms. Jocelyn. And just kind of like an overview of the program and what you can expect and ways to have success with it. And really a breakdown of how much money do I need and what's my dang payment, right? And how can I qualify? Well, the first thing that you need to do is you need to give us a call and have us run your credit and analyze your income. It all starts with a phone call and intake to figure out where you're at. And at TDR, if you don't qualify for a loan right now today, we will put you on a path so that you can qualify, 2 months down the road or six months down the road, or don't worry, we got you. Calhfa has been around for a very long time and they have a lot of money. And it's a program that I strongly believe in. A lot of buyer programs will run out of money. Maybe they're not that reliable. The funding source decides they don't want to do it anymore. And my experience with Calhfa is that's never been the case. I've found them to be a very, very reliable organization, and you can close in a normal time frame. The Calhfa people are so amazing. I just got off the phone with a gentleman. What's his name? Tom Nan, who is the lender services manager. And he gave me a little breakdown of why the income limits went up. I didn't really understand it. Did you guys? Just a different. Have more people get in. Yeah. Just a different. It's the TBA finance model that they're using now, and they used to use these like Section 8 model where you qualified if you on a 1 to 8 people, and one person could only make like 55, and if you had 8 people in the home, you could make like 80,000. And with home prices being where they're at, if you make 60 grand, you're not going to buy a 350 or 450 house. And so having the income limits in the Inland Empire go to 128 is so legit. It's amazing. So we're really excited about it. The Calhfa program offers, in Orange County, you can make up to $174,000. And I did a little breakout. So in Orange County, that means if you make 174 grand, you can probably qualify to buy a house around $629,000. And you'd only need about $4,000 cash to close. $4,000. Like, you guys should be cheering in the background. And your payment is around $4,600, kind of somewhere in there. That would be an FHA loan. In the Los Angeles County area, along with Riverside and San Bernardino, well, let's go to Los Angeles County because they have higher loan limits for FHA. So in LA County, now you can probably, if you make $128,000, you can probably purchase up to a $500,000 house. What a blessing, because there are no $300,000 houses in LA, or barely even any $450 houses in LA. So how much? Like 5. Yeah, you do 450 or 5. So that is really a blessing for a lot of people. And same thing, you'll get in for around 4 or 5 grand. Your payment on 500,000 will be around $36.94, kind of somewhere in that area. Now in Riverside and San Bernardino County, I'm pleased as punch to see that we're on par with LA County, aren't you guys?
Yeah.
That's really cool. Because usually we get the shaft out here in the IE.
You have more houses out here than you do LA.
That's right. Price. Yeah. So but the little caveat is, we have the FHA loan limit restriction. So in the San Bernardino and Riverside County area, you can make up to $128,000, but you're only going to be able to purchase up to $420,000 on the FHA program. and need around $4,000, $4,000 or $5,000 cash to close, and have your payment around $3,100. The Calhfa program, right now, the way it works is you have a Calhfa first, and that rate is set by Calhfa. And today, what is it today?
5.5.
5.5. And when it's 5.5?
Yesterday was 5.2.
5. Oh, it was 5.2 yesterday.
So it varies every day.
So it varies every day. Okay, goes with the market. And yesterday when we looked at an FHA loan that we were paying the closing costs, rates have really gone up. I was surprised that wasn't it 5%? I was like, 5%? When did that happen? Because we were paying all the closing costs, it seemed like only a couple of weeks ago, like 4.3. Yeah. So that's a big jump, gosh, in such a small time.
Still pretty low though, considering how it was 20 years ago. It's like 8%.
Yeah, I guess all you old timers out there remember that, huh?
Okay, fine. I'm old.
Okay, so what was I talking about right now?
About the Calhfa, and you talked about the down.
You said the rate.
Oh,
Yeah,
the
the
rate.
first.
Okay, the
The
first.
first.
That's right.
Now you're on the second.
So you have a first that's set by Calhfa, and then you have something called a My Home Second, and you can get up to 3.5% silent second at 2.5% simple interest. So it does accrue interest, but it's not like amortized. It's just simple interest. And then you can also get a third. That's right, a third. And that's up to 4%. That's a silent second. And the nice folks at Calhfa are saying you don't even have to pay them any interest on that at all. So isn't that nice of them? I thought so. Let's see. What else? Oh, Calhfa's. Now, calculating the income, the number one mistake that a lender can make on the Calhfa is not getting 3 years of tax returns and the 1040s. They're going to want to know that you're a first-time buyer. A first-time buyer means that you haven't owned a home in 3 years, which means you haven't written off any interest of your brother's or sister's house to save money on your taxes in 2016. You can't do that. Also, it's just you haven't owned a home in the last 3 years. And the income and owning a home are where most missteps occur. When you're qualifying for a buyer program, they look at how much you make now and what you're going to make. So if you're making, I don't know, $150,000 and you're getting a $30,000 bonus, and that's the first time you ever got a bonus, well, that's $180,000. So you're not going to qualify in Orange County. You're just not. For qualifying for the loan, though, we're only going to give you qualifying of $100,000 or $150,000 because that bonus has not occurred for 2 years. Then we don't give you credit for that. So knowing how to calculate income for the actual loan product versus how to calculate income for the program are super, super important to having success. To me, though, the biggest factor is setting up the expectation with the client, with the buyer's agent, and with the listing agent. We at TDR have a big success getting our offers accepted on our first-time buyers because we have a pretty solid reputation in the real estate community as being closers and knowing our stuff. And yeah, how to structure. You know, we really don't have fallout. And the Calhfa program, it's really no big deal. You know, if you can convey that this buyer has been with you for, you know, a month, you've got all their documentation, they're pre-approved, you ran them automated, they meet the income limits, and you can convey all of that to the listing agent, and you do it in a way that they like you and want to take your offer, then you're good to go. I think, why are you laughing? No, Clyde, when you're writing an offer, it's got a buyer program. Do you want to take that offer if you're a seller?
Typically, no, but if it's coming from TDR and everything is so well packaged, then you can gain the seller's confidence in your client that this deal will close, then you shouldn't have a problem because the seller knows you're going to close.
I think though, in a competitive market, it's naive not to think that it won't be an issue.
Oh yeah,
Because let's say you're purchasing something around $350,000, you better believe that the listing agent is looking out for their seller. And so, what loans are most likely to close? Well, people with high FICOs and money. So if you've got a 20% down conventional, sorry, first-time buyer, you're probably not going to get it unless
you have Clyde Hagan representing you.
It's tough, it's tough, and that's where your team is so important. Your team is really important, and how your agent communicates with the other agent is critical to the success of getting an offer accepted with a first-time buyer program. Okay. Did we cover this one being 350? The scenario, okay. So the actual scenario, where did I put it?
You put it on the thing, but you didn't put it.
Oh, I did. Okay. I'm totally organized. Don't tease me. Okay, so in an example where the sales price is $350,000, the payment is around $2,585 on FHA. So $350 sales price, the total payment $2,585, and you need about $4,500 cash to close. When you pay back the silent second and third, you'll pay that back when you sell or refinance. You'll pay back approximately $26,000. So you've got a little chunk that you're going to owe, but you're a homeowner. You're saving money on your taxes.
You're not renting.
You're not renting. The rents aren't going up. You've got a fixed
building
rate.
Equity.
Yeah, you're building equity.
So you can pay that money back without having to pay for it out of your paycheck.
Yeah, so it's a win-win thing. So that's the end of the Calhfa segment of our Compare and Contrast Buyer Program series.
If there's confused,